For almost a century, the US dollar has been the undisputed king, the world's reserve currency, the bedrock of global finance. Today, with America's protectionist policies, shifting global economic order, and a national debt spiraling out of control, that pillar might not be so secure anymore. In fact, the change might have already begun. If you look at the dollar's value against a basket of other currencies, it's been weakening for months. Meanwhile, the euro, despite the eurozone's own economic challenges, has hit multi-year highs against the greenback. A paradox? Maybe not. Some European leaders believe a stable euro could attract investors seeking alternatives and even challenge the dollar-esque global dominance. Hey, money explorers, welcome back to Money Made Easy. What we're witnessing isn't just currency fluctuations. It's a signal of a world starting to question the long-term economic stability of the United States, a world that might be slowly turning away from the dollar and the entire global order it underpins. In this video, we'll break down why the American currency is losing some of its shine and tackle a big question. Could the euro eventually dethrone the dollar as the world's dominant currency? Let's be clear. De-dollarization isn't a brand new concept. We've touched on it before here on Money Made Easy. But this trend is accelerating now, fueled by the ripple effects of monetary policies and a growing desire for monetary sovereignty across nations. China is pushing the yuan in energy trades. Russia is increasing the ruble's use. The BRICS nations and the Eurasian Economic Union are exploring alternative financial infrastructures, even central bank digital currencies, to bypass Western payment systems. A new world order is taking shape, and less faith in the dollar means less demand for US Treasury bonds. Less demand translates to higher yields, and therefore higher borrowing costs for the US. Considering the US budget deficit for 2024 was already a staggering $1.8 trillion, if investors start shying away from buying US Treasuries, the fiscal picture could get complicated very quickly. But before we look ahead, let's understand how we got here. The US dollar became the global reserve currency thanks to the Bretton Woods Agreement after World War II. Back then, America positioned the dollar at the heart of the new monetary system. It was the only currency directly convertible to gold. Other currencies were pegged to the dollar at fixed rates. Even after the US abandoned the gold standard in the 1970s, the dollar continued its reign. Today, it still accounts for roughly 60% of global reserves and is used in about 90% of international transactions. However, if we look at the financial markets now, we see traders selling off US assets en masse. There's a worrying anomaly. Normally, when bond yields rise as they are now, the dollar tends to strengthen. But the opposite is happening. Investors are ditching both US bonds and the dollar itself. Its pattern is similar to what we've seen in emerging markets during crisis situations. It suggests that markets are starting to demand a risk premium on US assets. They want to be paid more because they perceive them as riskier than before. It's not hard to see why. The yield on the 10-year US Treasury note recently jumped from 4.2% to 4.4%. In just 4 days, the fastest climb since 2008, the 30-year. Treasury saw its biggest 3-day surge since 1982, when you consider that US debt to GDP is around 100%. Basic math tells you that a 1% increase in yields equates to a 1% increase in the interest costs America has to pay on its outstanding bonds. We're talking about a mountain of potential cuts to public spending, or even worse, higher taxes for everyday Americans. And it doesn't stop there. Beyond trade tensions, Congress is poised to unleash a flood of public spending. We're talking about a potential fiscal package larger than anything we've even seen before. Bigger than the COVID stimulus and the Biden plan combined. This wave of stimulus has already put bond investors on high alert, because when the government borrows this aggressively, markets know it's playing with fire. The protectionist policies coming from Washington add another layer of complexity. Some key advisors have openly questioned the dollar's role as the global reserve currency, arguing that a strong dollar is a hidden tax on American manufacturing workers. Even the vice president has echoed this sentiment, suggesting the strong dollar is no longer sacred but a burden. Such statements were taboo for decades, and now they re-coming from inside the White House, a stance that could unintentionally trigger a global financial earthquake. For the US economy, while a weaker dollar could theoretically make exports more competitive, any benefit is likely to be wiped out by the chaos caused by tariffs. The real impact will likely be a surge in inflation. As the dollar weakens, imported goods will become more expensive. Tariffs were already inflationary, and the only hope was that a strong dollar could offset that. But with the dollar potentially weakening, inflation could climb even higher. And here's where it gets really interesting. If the Federal Reserve decides to raise interest rates to combat this inflation surge, the president might start pushing back hard to stop them. Clash between the White House and the independent Federal Reserve would be devastating for the markets. And if the president were to exert political control over the Fed, forcing them to cut rates while inflation is rising, the risk to the US economy would be explosive. The first sign would be a spike in yields, forcing Congress to act decisively, like they did in 2008. We'd need a massive fiscal response, rapid compromises, maybe even overriding a presidential veto to stabilize the budget. But is today's divided America ready to respond that quickly? And if the worst-case scenario unfolds and the dollar loses its status as the global reserve currency, what are the alternatives? The Chinese yuan is still viewed with suspicion by many international investors. China maintains strict capital controls imposed by the Communist Party, limiting the free movement of money. Beijing also regularly intervenes to devalue its currency to maintain export competitiveness. All of this makes the yuan unreliable for global investors. Japan is heavily indebted, and the Nordic countries are too small. Safe haven assets like gold and cryptocurrencies exist, but nothing truly has the weight and liquidity of the dollar. This leaves the euro as practically the only viable alternative. If the US economy continues to slow down and the European Union manages to strengthen its cohesion, the euro could become the least bad option, even if by default. Paradoxically, an increase in European debt might even help this shift. Think about it. Germany has just suspended its debt brake to increase military spending. At the EU level, there's a proposal for new Eurobonds, common debt to finance European rearmament. At first glance, this looks like weakness, but remember, it was the sheer volume of US Treasury bonds that helped maintain the dollar's dominance. Treasuries are the world's reserve bonds. They pay interest, are liquid, and can be bought and sold easily, creating a virtuous cycle. Dollars are needed to buy treasuries, and treasuries reinforce the dollar's role. The problem for Europe and the euro so far has been the lack of sufficient euro-denominated bonds in circulation. The market was too small, too illiquid, but now things are changing. When treasuries were sold off in recent weeks, many investors flocked to German bundas, and if confidence in the dollar continues to wane while Germany and the EU start issuing a growing number of bonds, that is debt, then the dollar treasury complex could indeed start to lose ground. Let me be clear, the euro won't replace the dollar overnight, but it could capture a larger share of global reserves. The world isn't necessarily looking for a new king, it's looking for a more balanced system. And this story, with all its geopolitical and monetary implications, will be one of the most important to watch in the coming months. As the US potentially reshuffles the global order, Europe quietly might be picking up some of the key cards. The strengthening euro reflects a shift in perception. Investors are starting to see it as a safe harbor, amidst potential US economic turbulence. This could mark a significant rebalancing of currency markets. And despite any potential policy shifts, the underlying uncertainties surrounding the US role in global trade and finance remain, potentially further eroding the dollar's safe haven status. We'll continue to monitor these crucial developments here on Money Made Easy. Let me know your thoughts in the comments below. Can the euro, if not replace, then stand alongside the US dollar as a global currency? Subscribe if you haven't already, and we'll see you in the next video. Happy investing!